So today was kind of bearish, okay, when you look at it at the surface, but we're going to dig in a little bit deeper and explain why it's not all too crazily bearish at this particular point in time. Now, as you know, we talked about the risk ranges in the prior video and how these mega caps tech stocks, they pretty much reached those levels right out of the gate on day one. Now we saw the market back off, okay? Today, we're going to get into a couple of more things that are bearish, but also from the shorter term perspective, not as bearish, okay? So you're watching the Stock Market Brief Show. My name is Michael Silva. If you're new here, well, welcome to the channel. We use technical analysis, intermarket analysis to get a good idea as to where the market might be headed next. Woo! Go ahead and hit that thumbs up if you haven't done so already. It is greatly appreciated. That's how you sponsor this video. Let's go ahead and get into today's show. All right, everybody, welcome back. So yeah, the top four sectors that were strong today were all defensive names, and those were the only ones that were actually in the green. Financials, tech, consumer discretionary, the three big dogs over there, they were all down in the red. Financials, not so much, and that could be because of the yields were rising. And, you know, when the yields are rising, that typically helps financials. Now, what caused all this shakeup in the market today? Well, the Fed did come out and somewhat spook the markets. We have an aggressive rate hike policy coming in and tightening cycle. It's going to be a very interesting time. But what is the bond market saying? Well, the bond market here, it's first and foremost, the long end of the curve, they are going into inversion. Now, the 10 and 2, that just came out of inversion, but it's still, you know, flat as a pancake. 35, it is inverted. When we take a look at other other curves here, like the 10 and 3 year, the 10 and 5, the 10 and 7, the 30-20, you can see those are all well into inversion. Now, this is why it's not as bearish as some people might see, like make it sound, at least in the short term. And the reason why is this is the longer end of the curve. If we look at the shorter end of the curve, the 10 and the 3 month, you can see here it's steepening. Okay, so the risk of a recession will really come when you start to see this head closer and fall at a rapid rate towards inversion. Now, you know, it's a very interesting time because when you take a look at like the 10 and 3 or the 10 and 2, the speed at which this moved into inversion was quite rapid. And we're seeing the volatility increase in the markets. However, when you take a look at the shorter end of the curve and it's continuing to rise here, to me, this states that, okay, a very short-term time period, a recession up ahead, doesn't seem likely. But what does make me, when I look at this, how I'm interpreting it is we're going to see continued volatility throughout 2022. So it's going to be a rough trading year. I don't think it's going to be very directional in any way unless if we break out of some key levels. So this is a very important curve that we do want to pay attention to. This was watched very closely pre-COVID, and now we're going to be watching it closely closer here going forward too. Now, if we take a look at the TNX, this is the 10-year yield. If we just draw a line from a 30 marker down to 10 and then in the middle 20, so what does that mean? It's 3% here, 2% here on the 10-year, and then 1% right here, okay? And you can see here this inverse head and shoulders. We broke out, found resistance at around the 2%, and then we started pulling back, and now we're firing back off. So what's crazy here is this inverted head and shoulders type of pattern, if it meets a full measured move, that brings us up to 3% on the 10-year yield. And that could further kind of, you know, go towards the theory here that we're going to see continued volatility in the markets, especially if we move at this rapid rate here. What can potentially happen? Well, if the 10-year yield continues to push up at a rapid rate of change, tech is going to get hit. It's going to probably get hit harder, or we're going to see more continued volatility there. Financials, depending, you know, at the rate at which this moves up, they can also get hurt. But financials typically like, you know, when the yields are rising, because banks, they do borrow short term, they lend long term. So this is just an important thing that I wanted to call out right here. I still think, you know, and one of the reasons why I say this is it was kind of bearish, but not really, is because the risk-off type of behavior didn't really happen in the market. So typically in a risk-off move, you can very well see bonds start to spike. And bonds, they got hit tremendously hard. We're constantly seeing volatility in the bond market. So bonds did get hit pretty rough. However, I'm still watching it. I still have a position on TLT. I'm going to hold it throughout this quarter, unless if, you know, my trade reaches max pain, which it very well could. It's not that big of a trade, but it is still something that I'm in at this particular point in time. Now, we do have earnings season coming up. Next week, we got a lot of bank earnings, okay? So I wanted to take a look here at seasonal charts for the TLT just to get an idea of maybe when they start performing. Well, as we're in April, right? So TLT, and we have bank earnings coming up. You can see here, actually, at the beginning of April, it's a little choppy to down. Then more towards the middle of the month, we start to spike up, then pull back down. It's not until May to mid-May is when TLT actually starts performing here. So getting out of kind of that seasonal period of earnings. Now, if you look at the relative strength between TLT and the S&P 500, you can typically see here bonds underperform the S&P 500 basically throughout the month of April up until just a little spike right over here into the middle of the month. So take that information how you want to take it, but to me this signals that the S&P 500 very well can outperform treasury bonds here in the month of April. Now, a risk-off move that did occur was we did see a significant move into the dollar, right? So this has been flagging and we broke out. We're at the upper Bollinger Band. So are we about to get a massive expansion here? Or are we getting a little bit of a head fake? I couldn't tell you, but overall, it looks like it's part of a continuation type pattern. So we'll continue to monitor that. A strong move in the dollar, and you saw the markets move down here as well. So if we continue to see strength there, it could continue to put pressure on the markets and also various commodities too. Speaking of commodities, oil is continually pinched between the 20 period and the 50 period moving average. And this thing, expansion, and it's getting tighter here. So there's going to be an explosive move. I can tell you that. It's going to be an aggressive move probably here in the near future. As far as the directional bias, right, it's very hard to determine. If you want to follow the trend would say, hey, it's probably going to be up. But that doesn't mean that we can't get some sort of a head fake prior leading to that. Just take note that this is probably a pattern that a lot of people are watching, and maybe not necessarily just the technical pattern, but a lot of people are paying attention to this contraction in the price of oil here, as well as XLE, which is energy stocks. Okay. Now, if you take a broader look at the markets here, if you take a look at like the Dow Jones hasn't gone anywhere since May of 2021. Okay, it has been in a trading range. All right, so it peaked out here, and then we've really been just going sideways. And if you take a look at something like IYT, which is the transportation index, they've been getting hit very hard, which is not a good signal for the economy. And it's been getting hit hard, so we might see some sort of recovery type move here soon. But overall, it's also been, a topped out in May, pretty much, right? It's been hitting resistance, and then it's been hanging out at these levels of support down here. So keep an eye on this range. If we start breaking down from the range, that could spell further downside in obviously transportation, but also it's not good for the overall economy too as well. It could be a good indication that we might have more troubles up ahead. If you take a look at semiconductors as well is a big portion of the NASDAQ. Semiconductors is really something that you should watch, especially if you are into trading growth stocks, right? So semiconductors here, what I want to call out is these red and green boxes. And the red and green boxes, I'm really highlighting the volume here because on the way down, you can see volume increase, and on the way up, volume kind of contracts. And then on the way back down, volume is expanding again. On the way up, volume is contracting. And then here today, we had a pretty big, nasty down day, 4.31%, and it was on some pretty big volume. So it does seem like a period of distribution. We got to see here if the bulls can recapture some levels. But the thing is, semiconductors make up a big portion of the NASDAQ. We have the transportation index too. They're struggling right now. And you can see that the curves are inverting. So there's a lot of bearish things, but also in the short term, it looks, it's not as bearish as people might perceive. It just seems like we're going to be continuing to chop around, and it's going to be a lot of head fakes here. So it's going to be a very difficult environment. Now, another, little image that I want to show you. I think this was from Martin Pring. You can see here, contracting volume on rallies is bearish. So you got to always watch for those divergences, right? So price goes up, volume contracts, price goes up, volume contracts here. If we take a look at the housing index, that was down 2.74% on the day. This is another huge sector that you want to be mindful of, right? This big rally here in the S&P 500, look at what happened in the housing index. It didn't even budge. And, if you date back to 2005, the housing market peaked. And then it started kind of heading lower, kind of going sideways. Meanwhile, the S&P 500 continued to rally. And it wasn't until later where the S&P 500 peaked, but the housing index gave a good insight of the Great Recession. And what we're seeing now with like 30-year mortgage rates just blowing through the roof, we're seeing the housing index really struggle here. And you can see that it did peak out in May. Meanwhile, the S&P 500 continued to rally here, and it just keeps getting weaker here. So we need if you are bullish and you want to see the S&P 500 continue to rally on, housing is going to have to participate at some point, and it just hasn't done so as it stands right now. Okay, on a couple bullish fronts, we do have this still heading up, this is the NYSE summation index, and that's a positive sign. It started to curl over slightly here, but it's still above this little indicator that I like to look for shifts and change. Like for example, when the SAR, when we got above it and started showing dots below it, we started moving up, and you can see the market moved up higher. And then it also gave indication on this turn right here. Bam, it started heading lower, the markets. So that is something that we're paying attention to. I'm paying attention to. If you take a look at the 9-month down here too, this is pointing straight down. It's still above zero, and we did call out that negative divergence right here, and we're starting to see a little bit of weakness there in the markets, but nothing to be overly too concerned. Just note that volatility's here, and it just doesn't seem like it's going anywhere. Pring bottom fisher also is making a little bit of a turn. Last time it made a turn was right here to the upside, and we talked about it. Didn't think we were going to get this massive of a rally, but we did, and now it's starting to turn down. So are we going to start seeing some more weakness? I don't know, couldn't tell you, but it is something to just be aware of. Now, where's the opportunity going to be? Let's look into the risk ranges for today. IWM, this is going to be interesting to see. So IWM, small caps, as well as tech got hit the hardest. Now, yesterday video, right, we talked about the risk range on the Qs, all right? And the Qs were reaching the upper range, and they got there on day one, okay? And then now they kind of started to back off. Well, now the IWM is reaching its lower risk range, which is right, next to the 50-period moving average, right next to the 20-period moving average, and right near all these prior areas of resistance, and resistance can become a level of support. So one has to wonder, where can the opportunity be potentially tomorrow or the following days? And when I look at this, I think the opportunity could potentially be in small caps. And you got to think in terms of a short seller, right? If short sellers stepped in and did short into this move, I mean, it's up. It went down 2.37%, so they're doing quite well. So you have to wonder, where would they start to cover? And if they start to cover when everything's super down, where can potentially people start moving to? And you may very well be seeing tomorrow some potential short squeezes. Maybe the next day, I don't really know, but one could speculate that could be a potential place. So looking at various stocks in the IWM may be a place to keep an eye on. And I tell you what, I mean, the entire heat map was just solid red for the most part. So be on the lookout. This could very well just flip and change tomorrow. Could we get follow through? Absolutely. But like I said, it's been very, very volatile here and chopping back and forth. So, big green day goes back to a red day, and then we move up, and then we go back down. So would you be shocked to see this be an inside trading day, or to come out maybe a little bit and then come right back in? I wouldn't be. All right. So that's kind of where, where my head is at, being tactical in this environment. Meanwhile, the SPY slightly down on the week, right? We started moving higher. We put in a higher high, but we also put in a lower low. All right. So still very volatile. We haven't taken out this last week low, but if we do, I think that opens the door to go retest the 200-day moving average. I think that's more than possible, but we're just not there quite yet. If we take a look at the Qs, pardon me, if we take a look at the Qs, also you can see we came up to the upper risk range, but we didn't quite reach it. We just gapped down, and we just basically sold off throughout the day with some chop. We didn't take out the week's low yet, right? There's only been 2 trading days, and we're slightly down on the week. So basically unchanged on the week so far. So that leaves room to go back up, and that leaves room to follow through down. As far as where we can potentially start heading lower, I would say if we take out last week's low, that will open the door for the lower risk range. But honestly, right now, it's very hard to find a trade. And I think that the only trade that I can really kind of comprehend in the tactical environment is looking at the IWM, because we're down there at the lower risk range. So when I think of things in terms of risk to reward, okay, if I entered in throughout this range and said, I'll just stop out over here or even closer, okay, so be it. I'll take that much risk, but I might get reward all the way to the upper risk range, or maybe even to the middle, which would still make for a good risk to reward here. And you can look at individual stocks that might help you out there too as well. So that's just kind of where my head is at. That's all I got for you, everybody, on today's episode. Like I said, today it was bearish, kinda. All right. So yeah, I'll see you back here on the next episode. See you later.